Welcome to Do You Ever Wonder? The show that brings you answers to many of the questions that you may have, but with no one to ask. Do You Ever Wonder is hosted by Mike Haltman, CEO of Hallmark Abstract Service, who, like you, has always been deeply curious about a wide variety of topics. Each week, Mike will be speaking with guests who are leaders in their field and who have inspirational stories to tell. So now, sit back and enjoy the show.
Hi, everyone, and welcome to another episode of Do You Ever Wonder? And I would like to welcome today's guest, Charlie Hardage. Welcome, Charlie.
Thanks, Michael. Pleasure to be here.
Oh, terrific. It's great to have you. And I don't know if it's just me, but I always get the urge to stand up and dance when that intro music's on. But I try and,
I don't want to scare your listeners or I guess the viewers away from seeing me dance. So that's why I decided to sit down.
All right, good.
Yeah.
It's a catchy tune, though. But so Charlie is the co-founder of H&K Investments, which is a multifamily syndicator. And we'll get into a little bit about what multifamily syndication is and, how you provide value for your clients and how you maximize their investments. But first, Charlie and I met through a mutual friend, Marques Ogden, who has an incredible story. I actually interviewed Marques, I guess, about 2 months ago, and he's created a platform, a podcast that he's grown to huge proportions in a very short period of time. So Charlie has met Marques and kind of works with Marques.
Yeah. I think it was June or July of 2022 when I had met him, reached out. He has a coaching program. I believe he was just about to start his podcast. I don't know if he had done recordings or if it was just released. I don't remember the timeline, but his podcast has exploded more than I could have even thought.
Oh, or dream of.
Yeah.
So, as someone who tries to do a podcast episode a week, getting to his level of success takes time. But
It does, yeah.
you know what? More power to him. An unbelievable thing.
Yep.
So let me ask you this. I have a master's in business administration, which kind of speaks for itself in terms of what it is. So you have a master's in info and knowledge strategy from a great school, Columbia.
Yeah.
What exactly is that?
My undergrad is in international business. I didn't know what I wanted to do when I was growing up. I always had a real estate bug, but didn't really know what I wanted to do. And I always been, I figured I wanted something in business, kind of general. And at the time I was fluent in Spanish. I don't speak it anymore. And it was one of the, easiest routes to take. And after that, I was always kind of wanting to get an MBA, like you. However, I didn't really care about the finance piece or the marketing piece or some of those, and just really wanted to be able to build a better business, better organization. And I found Columbia has a program called Information and Knowledge Management Strategy. And when I was learning about it, I was just like, man, this is great. It's kind of like an MBA, but it's more of the soft skills. So it's how in my cohort, there's, I think 17 or 18 of us. Some are in business, some are in nonprofit, some are in government. And so you didn't have to be, from the tech space or from this or that. But what was really neat about it was we worked on how to build a collaborative organization. How can you build trust in the organization? So, again, and for my case, the business side of things, I was in tech at the time. I just wanted something that could help the overall business from more of a general standpoint to, better communicate, better collaborate. How can we take all this knowledge that we have as a group, as an organization, and build up the organization? Not strictly from a finance perspective or marketing perspective. So that's a 30,000 foot overview. Some companies actually have what's called knowledge managers. Those are going to be the bigger companies, but they typically reside in like the HR department or learning and development. Yeah.
That's great. I mean, one of my daughters is in tech startup space, and they have like happiness managers and employee experience managers. But what you're doing is it sounds very valuable. And if in my MBA, a lot of it was theory, a lot of it was not applicable to necessarily real world things.
Yeah.
And it sounds like yours is definitely applicable.
Yeah, I really enjoyed it. I also really enjoyed when I was done because it was a lot of work, but I feel I learned so much from it. And, I actually didn't even know knowledge management was a career path.
Yeah.
I thought it was just kind of more of a generic degree, and it worked. There's only a few knowledge managers in the program, and so they were, light years above everyone else. But it was a phenomenal program, had some phenomenal faculty, multiple time authors and all that. So I feel like it was a great use of time.
You know what? I'm glad I asked
Yeah.
because
There's
it's
not many of us.
yeah. No, it sounds very valuable. So, H&K Investments, your space is multifamily primarily?
Yep.
And
Only.
okay. And your goal is to take underperforming assets and turn them into better assets.
Yep.
So, I know some of the surface level ways you can turn something into a better asset is to, I mean, everything's geared towards improving your NOI, but beyond raising the rent, what kind of techniques and how do you know something's undervalued? What, in your due diligence, what makes you look at something and say, hey, this is undervalued?
Yeah, great questions. And so NOI, just to go over that quickly, is net operating income. So it's all of the income from rent, pet rent, admin fees, laundry, vending machines, anything like that. All the income minus operating expenses. And so if there's a, I have a very intricate spreadsheet that I use all the time, too much sometimes. And just getting familiar with the market. What happens is when a property comes online, it's not on the local MLS. It's going to be on a commercial property website like LoopNet, Crexy, and then there's some others where the broker, the listing agent, will do this OM, this offering memorandum, anywhere from 30 to 50 pages, and it kind of talks about the market, talks about the asset. And they put their pro forma in there and kind of give their thoughts on what you do with the property. To be honest, I don't take their pro forma, take it with a huge grain of salt. But knowing, and at first it's kind of hard, you don't know what you don't know. And so I am in a mentorship group, which is super helpful, where I have questions. I could go to them. I don't go to them too much anymore because a lot of the questions have been answered and I know it now. But an underperforming asset can be really, it can be done in a lot of different ways. Or it's a property that can do better, in my opinion. And that maybe their expenses are too high. Maybe the rent is too low. Maybe they don't have amenities. Maybe there's crime in the area, and it's in the property as well. And so anything that we can do to make the property better and increase the NOI, through either increasing income and or reducing expenses, is something that we look at. And
So what geographic areas are you looking at?
I'm in Nashville. When I underwrite, I'm primarily looking in Middle Tennessee. I'll look within about a 3-hour drive of me as well. So Atlanta, Birmingham, Louisville, Knoxville, and then some tertiary, some smaller markets as well. I have partnered with people in Georgia, Augusta, Georgia, San Antonio, Houston, Birmingham. So when I underwrite, I'm primarily looking in within about 3-hour drive of me, but I'm open to primarily the Southeast.
So Augusta, would that be geared towards The Masters?
It's funny. We're about 5-6 miles from the Masters. One of the reasons I actually got into that deal, the Masters are only a few days, and they're we don't gear it towards the apartment that we own is not geared towards the people that are there for 1 week.
Right.
There's a lot of single family homes, where people rent them out for $5 to $10 a week, and these aren't super luxurious homes. They're nice, but they're not super luxurious homes, and that would typically pay mortgages for 3 months.
Right.
Really, I'm in Augusta for two reasons. Number one, my sister and brother-in-law used to live there, and so I was already familiar with the area. And number two, and really more importantly, is there's a military base there. And over the last, I'd say 5 years, Michael, it could be not quite that long, but NSA is actually moving a ton of their jobs there.
Wow.
And so cybersecurity is huge there. And so with the cybersecurity government jobs, they're paying well, number one. Number two, they are, don't want to say they're guaranteed, but they're, probably not going anywhere, right? During recessions, military government isn't hit nearly as hard as the normal people. And then number three, it was a small town that had adequate housing at the time. But now with all the influx of jobs coming in, they're building like crazy there. And so, and because my sister and brother-in-law used to live there, I saw the growth from, they were there about 3 years, and they lived kind of in like I'll say rural. It's definitely not rural, but where they lived at the time, there wasn't anything around them. There's an exit, and that was about it. And when I went back a couple years later, had multiple retail shops, grocery stores, storage. So, I mean, it's just blown up.
So what was it about this property that you viewed as improvable?
It's interesting because in real estate, what I love about real estate is there's so many different asset classes. There's so many different investment strategies. It's not a one size fits all. And so we bought this particular property from people that went in there and they spent a lot of money fixing it up, doing some amenities. But what they did is they bought out most of the leases from the tenants. And so they made a move. Now, this is not our strategy. This was their strategy of basically kind of, I don't want to say kicking them out, because they worked with them. They bought out their leases. And so that took the occupancy down to about 50%. So what they did is they had an influx of capital where they just renovated as many units as they could, as quick as they could, filled them up as quick as they could. And so the rent was well below the market rent at the time. And so what we did is we bought an asset that, it was underperforming because the market rents were too low, because they just had to fill them as soon as possible.
Right.
And then we've taken the rents to market level. We've added amenities as well. And so not only are they getting a brand new property, or a brand new unit, because the old owners did that, but now they're getting more of a community with amenities that they can enjoy, that their families can enjoy. And, because of the way NOI works and the cap rate or capitalization rate, we're able to go in there, buy the property, and then within 3 to 5 years, sell it and bring our investors nice return, double their money.
The question is, so you went in when the neighborhood was not what you envisioned it would become with the influx of NSA people. So did the cap rate that you bought the property at come down, forgetting about market conditions and interest rate conditions, but just by virtue of the fact that the neighborhood improved, did the cap rate that you paid come down?
It did.
So that's instant profits without raising the rents. So you
Right.
raised the rents, lowered the cap rate. So now you're in Schaefer City.
Yeah. Yeah. And when we underwrite deals, Michael, we always take a super conservative approach. And so if market rent is, let's say $1,000, we don't put $1,000. We might put $950. If expenses are, let's say, $4,000 a door, we for the year, we might say that it's 4,500 a door or whatever. We always try to overinflate the numbers, and then that way, if like an environment we're in now where the interest rate does go up, cap rates typically come up, which is not good for us.
No.
But we don't promise this is the cap rate, and we want to under promise and over deliver, which
Always.
everyone says that term. That's what we do through super conservative underwriting. And I don't know what the cap rate was when we bought it. I don't remember, and I don't remember the reversion cap rate. So the cap rate when we predict that we're going to sell it in 5 years, but we typically raise that by anywhere from 50 to 100 basis points, sometimes even more.
It's significant. So, as a real estate syndicator, how many investors do you have in that property?
And that one, it's 377 units. I think we raised about $17 million. There's about 70 to 80 in that one. That's one of the bigger ones.
Now, you caught my attention with raising $17 million. How did you raise? I mean, that's a reasonable amount of cash. How did you raise that money?
It wasn't all me. Let's start there.
Okay.
There,
It was friends and family?
yeah, and the going back to what I said, 15 minutes ago or so about the mastermind group. There's people in that want to do passive investments. There's friends, family, previous investors that we've worked with as well, and so it's not just, hey, I'm brand new to this. Let's go ahead and let's get after it. And we expect to raise 17 million. And also, to be very, very transparent and fair, that was my first deal as a GP, as a general partner where I was active. And so I partnered.
Deal.
I'm sorry?
Nice size deal for your
Yeah.
first entree.
Yeah, and what I love about multifamily syndication is these are big properties. There's a lot that goes on with it, right? So you got to find the deal, you got to underwrite the deal, got to come up with a business plan, got to raise capital, got to worry about legal and insurance and all that. Then when you finally close on the deal, you have an asset manager that, it's kind of like a property manager or a project manager, excuse me. And they manage the managers basically. And so it's not one person that does that. It's a team.
It's a big effort. So now, what kind of a return did you offer to your investors to entice them to join you in this venture?
I believe it was 100% return over 5 years. When we underwrite a deal, we look at it if it's under 80% return for our investors over 5 years.
And that's paid monthly?
No, so typically, because these are value add deals, we typically don't do distributions for the first 6 months. We want to get in there, stabilize the property. And then usually month 6 or month 7 is when we start doing quarterly distributions. And, those will range. The first year, it's going to be lower, might be, 3 to 4%. The next year might be 4 to 6%. The next year goes up and goes up and goes up. And
all laid out in the prospectus.
Yeah, and we do a pitch deck. We do we say an hourly webinar. I don't know if they've ever been under an hour, but and then I love talking to my investors because at the end of the day, I know how hard I work for my money. And so, Michael, if you said, hey, I want to invest, but I have 100 questions, I will answer all of them.
Smart.
And yeah, it's a lot of money, that people put into this.
What's the minimum investment?
I'm going to put an asterisk on there. Typically, it's $50,000. I've seen them as low as 25,000. I've seen them as high as 100,000. On one of the last deals we did,
It's have to be accredited investors.
no, not all of them.
Okay.
It does depend as well, and that's a great question because there's 506B and 506C. So 506C is accredited only. 506B, you can have, I think the number is 38 sophisticated investors and unlimited accredited. And so accredited means that you have a net worth of $1 million or more, not including your primary residence. Or You make $200,000 a year over the last 2 years, and you're expected to hit that number this year as well, or you and your spouse combined make $300,000 a year. In sophisticated, they don't fall, they don't have, they don't qualify for those. And so the reason I brought that up is in most of our deals, we will have sophisticated investors, and sometimes they may only have an IRA or a 401k that has 35,000 and they don't meet that $50,000 threshold. A lot of times we'll go ahead and take them because we want them to be able to grow their wealth as well.
Right.
And maybe they, we don't want to discriminate, say, hey, you don't have 50. Now, if we're coming close to that 38 sophisticated investors, then we may not accept them. So it really depends on a lot of things. But yeah, we'll typically accept less if someone understands what we're doing and really knows like what they're getting into.
That's good business too, because at some point they want to have more money, and
Exactly.
you want them to be happy. So, speaking of happy, do the investors also participate in the upside when you sell the property?
Yeah, absolutely. And so the cash flow, the distributions that we send out quarterly, I'm going to make a number up here because every deal is going to be different, but let's say we hold it for 5 years and there's an average cash flow of 7% a year. So they're getting 35% over those 5 years. And if we projected, let's say 105% return over those 5 years, then when we go to sell the property, they're going to get the remaining $70,000, remaining 70%, and their initial investment back. So yes, they do participate in the upside.
So on the, for a story that doesn't have quite as happy an ending, if for some reason, and I don't anticipate this happening, but if for some reason, if the property falls in value, do they also participate in the loss?
They will. And the worst thing that I've heard has happened is it was a property in Texas, and the worst I've heard from people that I would work with. Let me rephrase that, because I'm sure people have lost tons of money, but because we do very conservative underwriting and we don't just jump into deals. We have our mentors go over the deals multiple times as well. They'll give us feedback, and then we'll tweak our underwriting. The worst thing that I've seen that has happened is I don't remember everything that happened to it. I think it was in Texas. It was close to Houston. The hurricane that went through about 2017, I believe, Irma, I think, wiped out one of the buildings. There was a fire in one of the buildings, and one of the tenants actually passed away. It was natural causes, so it wasn't any crime or anything. And the worst thing that happened there was investors got their money back.
Okay, and that's a pretty bad situation.
It is. And, the other thing is the depreciation side of things. They still got depreciation on it. They just, they put in, if they put in 100,000, they got right around 100,000 back. And so what they lost there was the opportunity cost, right? They could have put that 100,000 in a different deal. Obviously they didn't know it at the time.
As operators of the property, the investors are lucky that the operators knew about insurance, didn't cheap out on insurance, really did what needed to be done, because I would imagine in the realm of trying to cut costs, insurance might be a place that people would look at, given the exorbitant levels of premiums these days.
Yeah, and we, one of the other things too, when we look at areas just in general, at markets in general, we want population growth, job growth, right? And so, and I don't want to talk ill about any other place or any other strategy, but maybe let's just say, a market 15 years ago when the Great Recession happened, or Great Financial Crisis happened in Detroit and some of those areas where a lot of jobs were just lost. I'm sure people lost money there because all the jobs, a ton of jobs went away. And so we do look at markets where there's population growth and, landlord friendly states. Not every state is landlord friendly. They might say they are, but they're not.
Well, as somebody who lives right outside New York City, I can tell you that New York State is ridiculously landlord unfriendly.
Yeah,
So I don't know if you were talking about New York, but
possibly. But
definitely a challenging place. And the statistic is that I think 75% of landlords are like onesies and twosies.
yeah,
They buy these properties for the cash flow to live on. You know, COVID killed them. Now they're talking about New York about a thing called good cause eviction, where you can't even get rid of tenants.
yeah.
Increases are, well, that's a whole nother story. We'll go into that one day. But in terms of I've been looking at this a lot lately. Technology as a tool to lower your expenses and increase NOI. So when you go into a property, are you doing that kind of thing? Whether it's keyless door locks or being able to monitor each tenant's energy usage, or are those the kinds of things that you're looking at now?
Absolutely. And it's interesting because there's so many different platforms out there. But generally speaking, the smart home package, the technology package, everyone is familiar with that standard package of, a Ring doorbell or a Nest doorbell, security cameras, Nest thermostats, all of that. So there's definitely ways, just from that little, that everyone is familiar with. A lot of people have them on their homes now, and a lot of new homes are even built that way.
Yep.
So that's a really nice way. And then if you go another step further, there's companies out there that have the like a platform. They have their own software where a property manager can say, hey, this property is vacant right now, so let's switch that to vacant mode. So that automatically turns off all the lights. So that automatically turns down or up the AC. The door's locked. If a painter needs to get into the unit, you can give them a 1-day code. And so not only are you bringing down operational expenses, you're giving your leasing staff a lot more, and maintenance staff more time back. And so maybe you don't have to, maybe they're a little happier because they're able to do it from their computer.
100%.
Yeah.
100%. So, oh, go ahead.
Well, the other thing I'd say about the technology package is it's also able to increase the income, because a lot of tenants love, especially with families, they have kids. And so they want to know, in one of the complexes that we have locally, some of those kids, they go to the property before their parents, they may be working. And so they want to know that they got in, right at the same time that they always do. And if they didn't, they can figure out, hey, what's going on? So they'll pay a $20, $30 more a month.
It definitely pays, right? It pays for itself, and in
Yep.
the end, it increases your value. I was at a meeting where there was an owner of multifamily in New York who also managed upwards of 100 buildings,
Oh,
and
wow.
he was talking about the technology, and how he said that he went to refinance a building, and the lender had to go over the underwriting a second time and question the fact that his expenses were so low relative to the size of his property. And it's all because of the technology that they implemented. The fuel costs, in a New York City building, if you can save, whatever percentage it is on fuel costs, it's incredible.
Yeah.
So, yeah, and I think technology for you in buildings that you buy can make an unbelievable difference.
And
So,
yeah, and even you mentioned fuel. We work with a company that will do water conservation as well. And so they put low flow toilets in there, and they actually have sensors to show if there's a leak or not.
that's huge.
Yeah, and just because of the way commercial property is valued, you can go in there and save maybe 35% on your water bill.
It's a lot
And
of money.
depending on how big it is, could be millions of dollars
You know
increase in
what?
value.
I went down to my base. I have a gym in my basement. I went down there, and my son was home from Ohio for a couple of days, and the toilet down there must have been running for 2 days. And it's
Yeah,
like, if you extrapolate over a 200 unit apartment complex, that's real money.
lots of money. Yeah.
Some money. Well, Charlie, this was great. I really appreciate you coming on. You're obviously on the right track. You obviously know what you're doing, and I predict great things for you in the future.
Thank you, Michael.
Same.
Yeah, thank you. I was honored to be here.
Well, this was great, and I want you to come back on when you have your newest complex that we can talk about.
Sounds good. Hopefully it's soon.
All right, and listen, happy holidays.
Thank you. Same to you.
Thank you.
Thank you for listening to Do You Ever Wonder? And we hope that you enjoyed the show. Next week, we will have another terrific guest telling their story. And if there are any specific topics you'd like to hear more about, please don't hesitate to let us know. Our curiosity, like yours, knows no bounds. Please subscribe and like and share this episode on your social media. See you next week.